Well, it's 9/11 and is the case every year on this day. It's a little bit more solemn, a time of reflection. Many of us recall where we were when we first heard that horrific news. I was sharing my story with my students earlier today, and I'm sure many of you were affected to one degree or another, so our hearts are with you. Also, thank you to the first responders that are out there, all of you that give of yourself to be firefighters and policemen and EMTs and everybody else that goes in there to bettering somebody else's life. Thank you on behalf of all the rest of us. Another thing that's kind of in the news here today, of course, is there's a big hurricane that's barreling towards the Carolinas. So those of you that are in the path of that hurricane, I hope you seek out some safety and things end up being a little bit easier than as currently anticipated. But of course, the stock market rolls on. We did have a strong day in the stock market today across most indices, but we do still continue to have a bearish intermediate term posture on some of those indices. So we'll take a look at that, and then we'll take a look at a trade application example from one of the stronger sectors here recently. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's September 11th, 2018. For those of you that are new, first of all, welcome aboard. We're grateful to have you in our audience here tonight. Remember, you can go over to YouTube and subscribe to our channel so that way you don't miss any of our future videos. In addition to that, you can also sign up for our email distribution list in the description area of YouTube. That would entitle you to receive a notification whenever we do post these videos, in addition to having all the stocks that are giving you overbought and oversold cluster signals within the S&P 500 sent to you via email as well. Now, we're also heavy users of Twitter. My handle is @BrandonVanZee, all one word. I would encourage you to click like and retweet on all of our market outlook related tweets that are out there. It just gives us the sign that you guys appreciate the videos and you want us to continue to do them in the future. And then lastly, we also have a presence on Facebook. You can see the group web address embedded in the logo in front of you, so feel free to jot that down and join our group over there. All right, with that, let's go ahead and dive into the analysis of today's markets. As you can see, I've got chart 4B pulled up in front of us here. Remember, for those of you that are premium Market Scholar subscribers, you can always kind of follow along with David and I's presentations, whether we're talking about these market outlook videos or in our premium trading rooms that we teach each day, by looking at that pink label in the upper left right there. So 4B is the one that we're on right now. And this particular chart setup is going to allow us to see all four of the major US indices side by side by side. So what it allows us to do is see if there's any differences that we'll want to be aware of out there. The other thing that you'll want to know is that these are all 3 months in length. Each one of the candles is 1 day in length. And when you see the background color of the chart pink, as we do right now with the S&P 500, that signifies that we have a bearish intermediate term posture. Now, this would be considered a weekly bearish posture. We know that because that color of pink is light pink, as we see right there. Notice there is a difference over here with the Dow Jones, for instance, back in June, where it was dark pink. That would be considered a strongly bearish posture. So right now, we do have a weekly bearish posture on the S&P 500. However, like I mentioned previously, over here on these candles, when we had a pink posture for just a day, that because we have price above a rising moving average, I don't know if I'm going to think too hard about this bearish posture. If we start getting broken down support, it's a different story. But right now, price is still behaving itself. Some of you will say price is king and it's the only thing. And if that's the case, then obviously you're going to continue to think about trades that could be both bullish or bearish, depending on the trade setup itself. But right now, do be aware that we do have a bearish posture on the S&P 500. But like I mentioned before, the nice benefit of looking at all of these indices side by side is that you can see where we have some outliers perhaps. And we do actually have one in the case of the Dow Jones. Notice the Dow Jones continues to have a bullish posture. We know that because the background color is green in this case, and you can see that the green line is still in the upper reversal zone, which is why we have that bullish posture retained. Notice over here with the S&P 500, that green line fell out of that upper reversal zone, which is why we have that bearish posture right now. So right now, The Dow Jones seems to be maybe a little bit more resilient than some of the other indices. And in fact, if you take a look at all of the candles here recently with all four of these indices, you'll notice that the Dow isn't all that far away from its most recent high. When you look at some of these other indices, look down below here with the Russell 2000 as an example. Today's candle is quite a bit further down than where we were trading a couple weeks ago. Same thing can be said for the NASDAQ. And so the Dow, not necessarily the strongest here on a daily basis, because we did have the the NASDAQ up 0.61, but over the last couple of weeks, it's gone down the least amount. So it has less to kind of make up, and that's why it retains its bullish posture. The NASDAQ and the Russell 2000 also have weekly bearish intermediate postures. However, I would point out that the NASDAQ's candle looks pretty strong here today, pretty robust. That's the type of behavior you want to see out of an index, where we have this nice set of higher highs and higher lows that has developed on the NASDAQ. And then when we pulled back, we still haven't broken significant support. In fact, what we did was we bounced off of that rising 30-day moving average. Notice that the NASDAQ closed near session highs here today, which does kind of distinguish it a little bit from what we saw out of the Russell 2000, where we didn't get quite as much juice to the upside. So keep your eyes on the NASDAQ. Obviously, tomorrow is a very big day for tech stocks because we've got Apple with its big product lineup announcement, and a lot of folks are expecting a new iPhone. So that could then cause some reverberations throughout the rest of the tech space, as there's a lot of components and other suppliers that go into those iPhones if the audience likes what they see. Let's go ahead and take a look at our next chart setup now, and this will be chart 4C. This will be our 3 green arrows chart setup. And in this case, there's not a whole lot to report because in all 4 of our charts cases, we have a mix of green and red arrows. In fact, in all 4 of our charts cases, it's the moving average that retains its green arrow. So you can see that right here with the Dow. There's the S&P 500. There's the NASDAQ composite. And then there's the green arrow for the Russell 2000. Unfortunately, you'll find that down below with the MACD and the stochastics, we have red arrows for both of those particular indicators on all 4 of our charts. So this is kind of a a wait and see type of a market, where we're trying to see, is this pullback that we saw over the last week significant enough to lead to a further breakdown in the charts. Right now, the charts are holding up reasonably well, but they're not as firm as they were a week ago. So I don't think we're to the point of writing this market off at this point. Then again, we have to be respectful towards the fact that we are in September, a month that is notorious for some stronger market crashes in history. And so you just never know when something might creep out of the blue and smack this market around. But right now, what I would say is we're in kind of wait and see mode. We're in fine place from a price perspective. It's just that some of the other indicators are giving us a little bit of wear and tear. All right, let's take a look now at our next setup, which will be 4D. This particular setup is going to be a little bit different. It's still going to be the same 4 indices, but this is going to be a long-term view that we're looking at here. Each one of these charts represents 3 years in length, and each one of the candles that you see on the charts represents 1 week as an aggregation period. We call this our 1040 crossover method, and you'll notice that on each chart there's an orange line that represents the 10-week exponential moving average. We also have a blue line that represents the 40-week exponential moving average. And what we're looking for are crossovers of the moving averages themselves. And that's what defines whether the background color of the charts are going to be green or pink. Now you'll notice that our charts have been green for quite some time. In fact, over 2 years in all of these cases. And so as I might remind you guys regularly, for a long-term oriented investor, maybe somebody who's just sitting out there with money in their 401k plan that can't really trade that actively in individual stocks, but they can kind of allocate towards big indexes, well, maybe this is an approach that you could consider. As long as you don't have choppy markets, it does a reasonably good job. After all, if most of you would have gotten into the stock market back here in April of 2016 to the long side and continue to hold until today, you're probably quite thankful for that. Let's go ahead and now take a peek here at our next chart setup, which will be our intermarket analysis 12 grid. Now for this, remember the background colors will go back to the market forecast way of identifying posture. And so we're using the intermediate term line on the market forecast indicator to determine whether we have a bullish posture or a bearish posture. So with this first set of 12 grids, it's kind of all over the map because these are all things that are outside of the stock market. So things like volatility and commodities and interest rates, et cetera, et cetera. So what I'm typically looking for with these 12 grids are any sort of strong trends or reversals in trends. And as it stands right now, we don't have a whole lot to get excited about from those perspectives. I would say that one of the kind of key events of the day was we did have some substantially stronger interest rates. The yields, I should say, were up here today, at least on the 10-year treasuries. And of course, the opposite side of that coin is that bond prices themselves fall. So remember, when interest rates are rising, like we've seen here basically for the last, let's call it 2 or 3 weeks, that's generally a better environment for some of the banks and brokers that are out there. Maybe a little bit less helpful for some of the utilities and REITs. On the other side of the coin, be aware that just like in the stock market, interest rates can use technical analysis as well. And as you see, when we're looking at this chart here, kind of in the upper left, the second from the left there up at the top, you'll notice that after a really significant rise in yields, we're right back up to a key resistance area here in yields, right around that 3%. Remember, when you're looking at TNX on the Thinkorswim platform, you'll want to take that decimal point to the left just one. And so you're basically at a 2.97% 10-year interest rate at this current time. So right around that 3% yield is where we've seen sellers of yields come in and buyers of bonds. And so as we approach that level again, it is helpful to remind ourselves of that because we don't want to get overly aggressive on our interest rate types of plays if we're about ready to see a potential reversal. Now, we don't know if that's going to happen. In fact, today's candle was very, very strong. We closed near the highs of the day, so we could very well slice through that to the upside, for all I know. But if we do start to get some kind of rounded tops up here, then just keep that in the back of your mind. Other trends that we've been looking at here recently have been the dollar and how that's impacted some of the commodities out there. The dollar was up today, at least UUP was up today by 0.08%. But as you can see down below here in the lower left, we do retain a bearish posture from an intermediate term perspective because it's at 44 and falling. But we're still at a rising moving average. We're basically just hugging that moving average for many of the most recent candles there. So again, I'm not to the point of writing the obituary for the US dollar at this point. As we look at some of those commodities that are impacted by the dollar, remember usually when the dollar is strong, commodities are weak. And we have seen some significant deterioration in gold. However, it is worth noting that gold now has a bullish posture. We're at 50.58 and rising on the intermediate term line. Now, what would be helpful is if we can get gold prices above the moving average, first of all, and then beyond that, if we could break above this prior high from August 28th, that will give us some indication that a trend change could be in the making at that point. But it's been a really tough go of things for a lot of gold-oriented traders out there. Ag commodities continue to be in a downtrend as well. And crude oil actually had a nice burst higher here today. But that likely can be drawn back to the news that I mentioned before regarding the hurricane barreling its way over towards the Carolinas. And so, if we do see a lot of, infrastructure taking offline, it's possible that crude oil prices could firm up just a little bit. All right, let's now take a peek here at our next 12 grid. This will be our U.S. markets 12 grid. And as you can see, we've got the S&P 500 in the upper left here, again with that bearish posture, weekly bearish posture. As you're looking at some of these other charts, you'll actually notice that we have more U.S. sectors that have bullish postures than bearish. And so it's a reminder that when we have the financials and the technology sectors that are bearish, they cause a bigger impact on the S&P 500 than something like telecom, utilities, real estate. Those are relatively minor components of the overall market. Remember, the S&P 500 is market cap weighted. So that's the reason you can see a relatively small amount of sectors that make up the market bearish and still have the market itself with that bearish posture. But as we're looking at these charts, they don't look half bad. You know, even technology, you look at this chart up here, yes, it does have that intermediate bearish posture because it's at 64 and falling, but we had a nice bounce back day here today off of that rising moving average on technology. So there might be something there for those of you that are bounce traders. You see discretionary holding up reasonably well, had a strong day here, a nice engulfing candle right there. Industrials. This is the sector that I was mentioning in the intro that we've been starting to see some very positive price action going into. In fact, let me do this. I'm going to come over here to the internet real quick to show you something. Oh, and by the way, I've got our marketscholars.com website pulled up right here. Remember, you can watch these Market Outlook videos every day in our blog area at Market Scholars, whether you're a subscriber or not. And the one thing that we ask you to do is to give us 3 clicks if you appreciate these videos. And so you can see down below the video itself when you're watching it, we have 1, 2, 3. So if you could give us a like on Twitter right here, a thumbs up on Facebook right here, and then there's also a like for our website down below here, we'd certainly appreciate it. And thank you to all 108 of you that did that for me last time around. But I wanted to show you while we were over here on the internet my sector selector for the most recent week. Remember, I produced this on Friday afternoon/evening, depending on when I get it done. But what it is it's a way to look at the 11 different sectors that are out there. And I'm looking at them from 10 different perspectives. I'm ranking them from 10 different, mostly technical indicators and momentum-based philosophies. And I'm basically averaging them out on an equal weight basis. Well, one of the things that we did notice in the week-over-week rankings is that the industrials finally found their way into the big 3 up here at the top. That's usually the areas that I concentrate on for my Monday top-down trend trading class that many of you attend. But the industrials, if we kind of track our eye backwards with this big orange peg right here, you'll notice that in the last 3 months, which is what the time frame is that this is covering on the sector selector, we have not had a higher ranking for the industrials. This is the first time in 3 months they've cracked into the top 3. So we are starting to see a little bit more of that sector rotation taking place there. We also saw technology slip a little bit in the rankings from basically the 4th slot to the 5th slot week over week. So we're going to keep our eye on that as well, since technology has been such a stalwart of this market for the last couple of years. Financials have been perking up a little bit as well. Notice in the kind of the turquoise color down below here, financials have improved their rankings for the last couple of weeks. And again, that's a direct response to what I was mentioning a moment ago. We've seen rising interest rates in the last couple of weeks. So it's helping the financials and at the same time hurting the real estate stocks. Notice that in the purple here, we're starting to see real estate fall into the 4th slot here. So a lot of that has to do likely with what's been going on with interest rates. So with the industrials being strong, it kind of confirms what we are also seeing there on the charts itself off to the left-hand side here. You also see some strength in the staples, telecom, utilities, even real estate. While it's down the last couple of weeks, it's still sitting right on that rising moving average. So there could still be some positive price action out of many of these different sectors that are out there. But for today's trade application example, I did want to concentrate on those industrial stocks that were out there that I mentioned were making a positive move compared to the rest of the sectors that are out there. So for this, I want to come back on over here to chart 4A, and I'm going to go ahead and pull up CMI. Now this is Cummins, and this is the company behind the Hemi engine and a lot of other diesel engines out there. They're also doing a lot of things with electric engines and different things like that as well. So it's a little bit more of a high-tech type of a company than you would assume. But of course, where that is actually placed as far as the taxonomy of the market and what sector it belongs to is the industrial sector. And as you can see here, Cummins is kind of the tale of two cities at this point when we're looking at this 3-month chart. The first half of that 3-month chart was a death spiral. This stock was really, really struggling back here. And notice what was happening. We started to get all of these little green dots showing up on this chart. Now those green dots are going to identify candles where we have oversold signals. So notice down below here on the market forecast indicator, I'm kind of circling those green dots to identify times where you've got your green, your blue, and your red lines on the market forecast all below 20 on the same day. So this wasn't just your average pullback is the point I'm trying to make. This was an extreme pullback where we started to get some of those oversold signals. Well, Cummins did come out of this pretty nicely. You can see we had this nice bounce back, as we often do after we get some of those oversold cluster signals. We had this reversion to the mean move here in just 3 days' time. This thing went from basically 130 up here to 138 in just 3 days. But a lot of times that reflex type of a move does not lead to a longer term directional change of that particular security. And so to see it fall back the very next day was not entirely surprising. And then you really spent the next couple of weeks, maybe even the next month or so, tracking sideways, kind of between 138 on the top side and 134 on the bottom side. That's where you spent your time if you were looking at Cummins. And then finally, right around this time period right here, right around the time they were reporting earnings, they started to break out in greater fashion, where you would have looked at this stock back here where it was trading below that downtrending moving average. Your assumption probably would have been that this stock would fall back into that trap of lower lows and lower highs. But indeed, something else happened. This thing started to make a move higher and establishing a new residency above that rising moving average. That's generally considered a positive sign for a stock when it can pull that off, because it gives you the sense that it's a true reversal that's taking place. Since then, you can probably make the claim that you do have higher highs and higher lows. In other words, it's the definition of an uptrend. Well, where you see where we're at right now is we just received a bullish posture using the market forecast indicator. That's why that background color is green, but you can also identify it with your eye down below when you're looking at this green line going lower, going lower, going lower, and then reversing higher here and starting to roll up. At that point is when we get that bullish posture using that technical indicator. So here we are actually touching the rising moving average and also having a bullish posture. Not only that, but this is a stock that does have a fairly strong dividend raising history with a yield right around 3% right now as well, for those of you that are a little bit more dividend oriented, as I often am. In fact, taught my dividend growth investing trading room here earlier today, and it is posted for those of you that want to check out the recording. But for this particular trade here tonight, what I thought we would do is what's known as a bull put spread. So let me come back on over here to the trade tab and pull up CMI. In fact, I've got the trade pulled up here in advance just to save a little bit of time down below. What we're focusing on is the October contracts with 38 days left until expiration. Oftentimes we're looking kind of in that range of 20 to 60 days until expiration. So this one fits nicely within that time period right there. There are also some weeklies out there that you could have focused on, but remember, sometimes the weeklies are a little bit less liquid. Liquidity is a little bit more important with this trade because it is multi-legged. So you can see what I've pulled up down below here is the 140, 135 bull put spread. In other words, what we're doing is we're selling the 140 put, we're buying the 135 put, which creates a credit of $1.27. So it's $127 for every contract that you do. And remember, this is a trade where you start the trade by taking money into your account. And your goal is to hang on to as much of that $127, if you do one contract, as you can. And how you hang on to as much of that as you can is by having the stock stay above the short strike price in your trade setup. So in this case, $140. Remember, this is a stock that's trading at 143 right now, so it basically gives you a $3 head start. So as we look at that trade, remember that your true break even on that, if we were to get filled at $127, and by the way, there's your return on risk on that. I calculated that before my presentation as well. It's 34%. For those of you that don't know how to do that, let me show you real quick. You basically just take this max profit and divide it by max loss. And so if you want to see that real quick, 127 on the calculator divided by 373, that's your 34% return on risk. So you basically can make 34% on your money by taking this trade, and in assuming that the stock does not completely plunge lower. Remember, that's the one thing that you're looking for. Now notice that your break-even price while we're over here is 138.76, or actually 73. So 138.73, I come back over here to the chart, 138.73 is right there, actually, right where I'm pointing with my mouse. So in other words, if you think this stock has a greater propensity to travel higher above where I'm kind of circling with my mouse for the next 38 days, and this could be an acceptable trade, as long as the stock goes sideways, as long as it even just goes down but just a little bit, as long as it doesn't go down more than $3 per share, you should be good. So there's a number of different outcomes that could exist in order for you to see some success with this trade. Either the stock goes up, which is the assumption right now with the bullish posture, but if that doesn't happen and the stock ends up going sideways, you still make money on this trade because you do make money off of time decay with this type of a setup. And then even if you're just flat out wrong and the stock goes lower, you can still have a slight chance of making some money as long as it doesn't go lower too much. If it only goes lower by $2 or $3, then you're okay. But if it goes lower by more than that, that's when you start opening yourself up to some more losses at that point. Okay, so with that, let's go ahead and place that trade by hitting confirm and send, reviewing it one last time, and then shipping it off to the market. All right, well, I want to thank you for checking out the videos here tonight. Again, we're thinking about you out there in the Carolinas. Make sure you seek out some shelter. Don't play games with Mother Nature. Remember, you can always come back to the markets at some other time. Hopefully, you guys can help one another out there in your various neighborhoods as well. But the stock market continues to rock on, and you know, treading a little bit higher as of today as well. So for those of you that are a little bit more bullish, hopefully you appreciate that. As always, we want to thank you for tuning in here tonight. Best of success with your trades and your investments. Goodbye for now.